Hey everyone, and welcome. I am absolutely thrilled to have you here for this explainer. Today, we're putting on our expert investment analyst hats. We are going to look right past all the hype of the current AI supercycle to understand how Wall Street actually values high-growth stocks. We're tackling the ultimate tech valuation dilemma: numbers versus narratives. Because right now, let's face it, the market is moving incredibly fast, and figuring out what a company is truly worth requires a lot more than just skimming the daily headlines. Here's our roadmap for this explainer. We'll start by defining the tech valuation dilemma, unpack a crucial tool called the PIG ratio, and then dive into a real-world case study with AMD's massive AI pivot. After that, we'll contrast AMD with a fundamental guru framework using an IT company called E+. And finally, we'll synthesize narratives versus numbers. All right, let's jump right into Section 1, the tech valuation dilemma, and AI's staggering price tag. If you've been watching the markets at all lately, you know we're in the middle of a massive tech rally, and it's almost entirely driven by artificial intelligence. To really set the stage here, just wrap your head around this staggering figure: $5.8 billion. That is the revenue AMD generated from its data center segment alone in just the first quarter of 2026. According to the reporting, that was a 57% jump year over year. And the market reaction? Well, the stock absolutely blasted past $413 after hours. AMD has officially crossed the line from being just a PC and console chip maker into a full-blown data center powerhouse, led by their server CPUs and AI accelerators. But, that kind of incredible run-up forces us to ask a really critical question. Is it priced for perfection? How do we actually know if a stock that's riding such a massive narrative wave is worth its astronomical price tag? Because if you just look at traditional metrics like a standard trailing price-to-earnings ratio, high-growth tech stocks often look terrifyingly expensive. We really need a better lens to view this through.
So, let's get into Section 2, unpacking the PEG ratio, or as I like to call it, looking through the windshield.
The PEG ratio stands for price to earnings to growth. You calculate it super simply by dividing a stock's PE ratio by its expected earnings growth rate. Now, why does this matter so much? Well, a standard PE ratio is kind of like looking in a rearview mirror, right? It tells you what you're paying for past performance. The PEG ratio, however, looks straight through the windshield at the road ahead. It explicitly puts a hard value on the expected growth of a company. Let me give you a quick example to brilliantly illustrate the power of this metric. Imagine a company with a high PE of 30, but it's growing rapidly at 30% a year. That math gives us a balanced PEG ratio of exactly 1.0. The legendary investor Peter Lynch argues that's a perfectly fair trade-off. Now contrast that with a company carrying the exact same PE of 30, but it's only growing at 10%. That results in a PEG of 3.0, which is a massive red flag indicating the stock is dangerously overvalued. The general rule of thumb is that a PEG lower than 1 points to an undervalued stock, while anything significantly above 1 is a warning sign. Okay, Section 3. Let's move from theory to practice with our AMD case study, their pivot from PCs to the data center. AMD is literally a textbook example of what Peter Lynch would categorize as a fast grower. They've successfully shifted their entire core identity. They aren't just selling Ryzen chips for laptops anymore. Their Q2 2026 revenue guidance jumped to $11.2 billion, almost entirely driven by the data center. They are ramping up their Instinct MI450 accelerators and these massive Helios rack-scale systems to compete directly for the AI infrastructure build-out. It's an incredible narrative for sure, but what do the actual numbers say? What is truly fascinating here is the sheer clash between the past and the future. When we look at independent financial analysis from the boring finance guy, AMD's trailing valuation multiple, which incorporates yield, sits at an incredibly high 3.1. By any historical standard, that is tremendously expensive. But if you use Wall Street's forward-looking earnings estimates based on that massive AI growth trajectory, the forward PEG drops to 0.97. That's below 1.0. So the crucial takeaway here is this: the stock is only fairly valued if AMD executes perfectly on its future growth targets. There is virtually zero margin of safety for any execution errors. Because of that lack of a safety net, analysts have to model out very different scenarios. Let's objectively walk through these 12-month projections. Step 1 is the bear case. sitting way down at $135. This happens if AI revenue stalls due to supply chain issues or software hurdles, and the market violently compresses that high multiple. Step 2 is the base case at $185, where AMD simply executes well and their earnings catch up to their current valuation. Step 3 is the bull case at $260. For this to happen, you need a total lollapalooza of AI demand, flawless integration of their system designs, and gross margins expanding well past 54%. You are betting incredibly heavily on CEO Lisa Su's execution.
Moving on to Section 4, the Guru Framework, where fundamentals actually meet momentum.
Let's completely flip the script for a minute. Let's contrast AMD's hyper-growth, forward-looking AI narrative with a much quieter IT company called E+. According to the Validia Guru analysis system, which runs stocks through the published methodologies of legendary investors, E+ earns an elite A rating. To get an A stock has to pass the absolute strictest fundamental tests of Wall Street's top-performing historical strategies. There's no hype here at all. It's purely quantitative.
So what exactly makes E+ an A? Well, it hits the absolute sweet spot of both growth and value. It passes James O'Shaughnessy's rigorous test for 5 years of persistent earnings per share growth. It has massive price momentum, boasting a relative strength of 92. But most importantly, let's apply that Peter Lynch PEG ratio we just learned about. E+ was trading at a PE of just 14, but had an average historical earnings growth rate of 23.4%. That gives it a PEG ratio of 0.60. It heavily discounts its proven growth. Add in really low debt and strong insider ownership of over 22%, and honestly, it's a fundamental analyst dream.
Finally, Section 5, narratives versus numbers. Let's synthesize all of this.
Let's compare our two companies side by side. On one hand, you have AMD. It's a classic fast grower undergoing a massive pivot into the AI infrastructure space. Valuing AMD requires a deep, unwavering belief in their forward peg. You are focusing entirely on their future execution and their ability to capture a trillion-dollar compute market. On the other hand, you have E+. It represents fundamental momentum. Valuing E+ relies on proven historical consistency, low debt, and a valuation focus grounded strictly in past, tangible numbers that offer a very clear margin of safety.
Which leaves us with the ultimate question for you to ponder as an investor. When you buy a stock, are you paying for the company's proven past or its promised future? Both approaches, the forward-looking narrative of AMD and the numbers-driven fundamental reality of E+, use the exact same tools, like the PEG ratio, but they require entirely different levels of risk and trust. You have to decide which framework fits your own analytical approach best. Thank you so much for joining me for this explainer. Keep your focus sharp, and I'll catch you next time.